You've got the financial conditions that are showing us that liquidity is going to pick up. We've got gold confirming that. And now we're just waiting for crypto to do it. And we've seen NASDAQ following liquidity all the way perfectly. So I don't think there's anything wrong. If you were to close the gap versus liquidity, Bitcoin should be sort of 140,000. It's an amazing chart of NASDAQ versus global liquidity. I mean, it's 1 for 1. For asset prices, if liquidity is increasing, they all go up. The banana zone will accelerate later in the year because we've still got to digest these prices, move up, get through that 100,000 level, bit more digestion, and then finally you can start accelerating.
In financial markets, price action often feels chaotic, emotional, and unpredictable. But beneath the surface, there exists a powerful structural force that governs asset prices across all markets: global liquidity. While investors frequently focus on headlines, earnings reports, or social sentiment, long-term market cycles are overwhelmingly shaped by the availability of money, credit, and financial conditions. When liquidity expands, asset prices rise. When liquidity contracts, asset prices fall. This dynamic governs stocks, bonds, commodities, gold, and increasingly cryptocurrencies. Raoul Pal's current macro thesis centers on the idea that the global liquidity cycle is now turning decisively upward. After a prolonged period of monetary tightening, fiscal constraints, and risk aversion, the conditions are shifting.
Please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos like this. You can also check out our other videos on cryptocurrencies and the overall digital asset space and drop your comments and observations in the comments section below. Everything you do helps with the YouTube algorithm and immensely contributes to the channel's growth. Thanks and enjoy the video.
Yes, I'm still very bullish on Q1, and it's going to be a big test of my hypothesis that the liquidity conditions are coming over this Q1 period. But we've seen the changes to the bank regulations, the ESLR, which means that the Treasury can directly monetize debt by selling it to the banks. That increases liquidity in the overall system. We've got a potential partial shutdown of the government still to get out of the way. So we've got that, so they haven't been drawing down the TGA, the Treasury General Account, but that's likely to start happening as well. We're likely to start to see signals about the change of who's going to be the Fed chairman. And, if you see Rick Reeder, he's talking about interest rates are 100 basis points too high. So we've got a lot of liquidity conditions along with fiscal stimulus all coming in Q1. Because don't forget, the game here is for the Republicans to win the midterms. And they're going to try and juice the economy as much as possible. So we should see the ISM, the business cycle, starting to rise as well. So from everything I look at, it suggests that liquidity is coming into the system. The main liquidity source currently is the Chinese. So they've been using their balance sheet. Liquidity is starting to expand. The weaker dollar is one of the biggest indicators of liquidity as well. So for me, it's all here. It's just a matter of waiting for a catalyst of which to take this all off, because I think the market is currently trading at a discount to liquidity conditions and at a reasonably significant discount. So, if you were to close the gap versus liquidity, Bitcoin should be where we are today. We're around 90,000 as ever, doesn't move. It should be sort of 140,000. So there is a reasonable difference. Yeah.
Okay.
So there's a reasonable difference and some alligator jaws to close. It's an amazing chart of NASDAQ versus global liquidity. I mean, it's 1 for 1. It's 1 for 1. And it shows where global liquidity is going because it leads. So for asset prices, if liquidity is increasing, they all go up. There's something called what we call the everything code dominoes. It's what drives what assets and when. And it's all phasing. So gold, financial conditions leads everything by about 9 months. Gold perfectly reflects financial conditions, as does dollar yen, as does silver. They're all in financial conditions land, so it's in the future. So they lead Bitcoin. And you can put the chart against it very nicely, and there's a very clear lead lag between gold and Bitcoin, because Bitcoin lives in somewhere around liquidity, global liquidity. Global liquidity leads it a bit by 3 months. So what you've got is a phasing. So when we talk about a rotation, it happens naturally. Like we're now seeing as the business cycle picks up, what happens when the business cycle picks up? Commodities go up. What's happening right now? Commodities are signaling the business cycle is going to go up. That phasing is always prevalent in markets. It's always there. So when I see gold doing what it's doing, it's telling you financial conditions are easing massively. The biggest driver of financial conditions is the US dollar. The US dollar got absolutely murdered the last few days. We still expect it to go lower. That increases financial conditions. It tells us the length of the cycle because it lives 9 months further ahead than here. So it's like, well, the liquidity cycle can continue towards the end of next year now, September of next year. So everything seems to be playing out as it should be playing out. I don't know if you remember in 2020 over the pandemic, gold went first. I remember because I was buying gold and then ended up just switching everything into Bitcoin because Bitcoin becomes an outperforming asset because, gold can do a couple of 100%, crypto can do 5, 10x if you're lucky. So again, it's the patience thing. It's right. You've got the financial conditions that are showing us that liquidity is going to pick up. We've got gold confirming that. And now we're just waiting for crypto to do it. And we've seen NASDAQ following liquidity all the way perfectly. So I don't think there's anything wrong. I think we had a temporary aberration because of what happened in 1010 in crypto, and that'll clear out the way and we'll have forgotten all about it in 6 months' time. The banana zone will accelerate later in the year because we've still got to digest these prices, move up, get through that 100,000 level, bit more digestion, and then finally you can start accelerating. It's all about the risk curve. All assets are priced according to a risk curve. The least risky asset is Bitcoin. The most risky is a meme coin. So what happens is when Bitcoin goes down and liquidity is withdrawn, the most risky assets fall. What happened after liquidity was withdrawn from the US because of the rebuilding of the TGA and the government shutdown? The riskiest asset, Bitcoin fell. NASDAQ didn't really. So it always happens the same way. It happens in the credit markets with treasuries and emerging market junk bonds. It's always the same process. So if Bitcoin falls 30%, ETH's going to fall 40, Solana's going to fall 65, Sui's going to fall 70, and meme coins are going to fall 95. That's normal. It's just a normal risk curve. And so it's not about a lack of demand, it's about a lack of risk taking due to liquidity conditions and disposable income. So then let's play forward to what we talked about at the very beginning. What do we expect this year? The business cycle to rise. What does the business cycle do? It gives us all more money in our pockets, more confidence in the economy, more risk taking. So when you put the ETH Bitcoin cross against the ISM, it's the same thing. It's all the same thing. It's all the business cycle. And so when the business cycle picks up, people go out the risk curve. So what alts you own? Okay, that's the hard thing. That has always been the hard thing in alts, right? It's not, people think alt season and think it's your God-given right that your bag will go up, but that's not how it works. Particularly the more and more tokens there are, a whole bunch of this stuff is uninvestable, will never get investment. So you have to ask yourself, is there provable network adoption and attention? And those things give you a higher quality trade than, hey, XYZ thing is down 95%, it looks cheap. Is that going to work? To a certain extent, yes, because the liquidity flows through the market making, and what happens is it tends to readjust prices on a relative basis. But the best thing is just to think carefully about what you're buying. If you want to do alt season sensibly, you're pretty easy to buy Ethereum and Solana. It's not that difficult. I actually still think crypto is really misunderstood. Just how even people in the space are just like walking away. We can't have nice things. The cycle. I think there's a lack of understanding, analysis, and patience. That is a huge disconnect right now. I've never seen anything like it in a still a bull market economic cycle. It's weird. I think gold can still go further. I don't think it's clearly overdone, but I think it can go further. Can it correct, go sideways for a month or two, ease off a bit of the overbought because the RSI is like 97 or something stupid. But I still think it goes further because I think the dollar goes lower. And I think financial conditions have to be very easy to deal with the debt rollover and the interest payments on the debt. And gold follows that chart perfectly as well. Again, there's a whole kind of flow of how this all fits. So yes, I think it goes further. Silver, don't know, possibly. But, we're obviously wildly overbought now. Generally speaking, it should go on a little bit longer. Whether it's another 2 or 3 months, don't know. So I'm not really one calling a gold top. Would I buy it here? No. The risk reward is not good enough to buy.
Gold's recent strength is a powerful macro signal. It reflects easing financial conditions, falling real yields, and rising systemic liquidity. While short-term corrections are possible, Pal believes the broader trend remains intact. Silver may follow, though its volatility makes timing more difficult. The broader takeaway is that precious metals are validating the macro thesis. Financial conditions are loosening and liquidity is rising. This environment is precisely the one in which risk assets thrive. Recent crypto volatility has been exacerbated by liquidation cascades, leverage unwinds, and infrastructure failures. During extreme market events, exchange outages and API disruptions can amplify price declines far beyond fundamental drivers. Pal argues that much of the recent weakness stems from forced selling rather than genuine distribution. In such environments, exchanges and market makers often step in to provide emergency liquidity, temporarily absorbing massive sell pressure.
If you think of what happened in the equity flash crash in 2014, we saw something very similar, right? Big multi-billion-dollar companies down 80% in a minute, 3 minutes. A lot of those trades got cancelled by the exchange because there's regulatory bodies, there's all sorts of... In crypto, we don't have that. So what happened was the liquidation cascade starts, there's forced deleveraging, but then the Binance API went down for the market makers. That couldn't have been a worst possible outcome. Now, let's assume it just happened because everything was breaking at the time. No market maker was able to bid in these liquidation cascades. So they became much more exacerbated. So who then bought, because we couldn't as retail get onto the platforms either. We were pretty much shut out of everything. There was this whole discrepancy between Coinbase and Binance. So who stepped in to provide the liquidity? Sure, the market makers came back. They got some, but we know they got slightly impaired because everything shut down, they couldn't trade. And my guess is the exchanges, because it happened on a few Asian exchanges as well, probably had to use their balance sheet to step in to provide liquidity. Because if they hadn't, it would have broken everything. Everything would have kind of gone to zero. So it would make sense to me that that occurred. And nothing nefarious. It's like, what the f do we do? We need to do something about this. We need to provide liquidity. So you use your balance sheet and you buy whatever's being liquidated. So then you've bought a whole bunch of altcoins, Bitcoin, everything. I don't know how much, let's say the number's 10 billion. Who the hell knows, right? Now you need to get rid of that off your inventory because you can't hold it on your balance sheet. They're not a hedge fund. So then you've got to work it out. So how do you work it out? Well, you kind of do it like you did in program trading and equities, is you work it over time, which would explain why we got these weird, as soon as the US opened, 10 o'clock, the most liquid time of all of crypto, the slam. Because somebody uses an algorithm, what's the most liquidity? That's that time of day. How much do we need to get out of? Let's say it's, X, 200 million a day, whatever the number is, and you get the slam. And that had the footprint of that. We didn't see any other evidence on chain of others doing stuff. So it kind of made sense to me. And I think that created the liquidity gap the other markets didn't show. There's a huge amount of call selling by long-term holders. And all of these Bitcoin yield products, they're all based on call selling, really. There's some lending, some call selling. MicroStrategies cause a lot of call selling. So you've got that natural dampening of the market of people kind of extracting a bit of yield out of their long-term holdings. I think most of us would assume that that is around the 100,000 strike, that people have been doing that. And we kind of need to clear that out of the way so there's less delta hedging when it happens. We've only had 1 or 2 of these this year, but we were having it every single day before. So I think it's gone. I think it's gone for now. But people are still licking their wounds. There's less capital in the market. And, gold and silver had a big run. Tech stocks have had a big run. So speculative capital moves for the place with the fastest rate of return. And so speculative capital hasn't come back in here yet. And that kind of makes sense to me. It just takes a while to repair. I looked at the bear market lows in 2022 after that final leg down. Again, remarkably similar to now. It takes a digestion period, and that digestion period's not a few days. It's basically, a couple of months or longer. And I think we're just doing that. Regulation, well, we're still waiting for the stability app, the market structure. We still don't have this in place. So we're still a bit in the Wild West. And, all global exchanges, if they want to operate within the United States or in Europe, will end up with having some forms of regulations. So I think over time they get more regulated, and that's fine. But there will also be these small ones that are unregulated. Crypto is still the Wild West. It's a decentralized, financial market of which, who knows what can happen. I think the DAT market is probably cheap if you think crypto's going up. I think we've passed the first round of risks. We saw some people selling out of tokens, buying back their shares. I think in a full bear market, we might see more. But I also think we will see kind of corporate raiders buying the DATs, stripping the assets, if they're trading at a discount. I'm less worried than I was about the DATs overall. I think Michael Saylor's cleaned up his balance sheet as well by raising the fiat to take that risk off, using the new share structure that he's built. I think that helps. Many of these will just wither on the vine. They just won't do anything. And they'll trade at discounts to NAV until the discount's big enough to break up the company. That's kind of how it feels like to me. And we've seen these with closed-end funds. Other ones, like Tom Lee is doing, and others are actually trying to build value. He's got the VC part of his and public market investing part of his portfolio. That gives some convexity to the upside. So it's not just looking like an ETF that trades at a premium and you take some cash out and stick it into the underlying. I think we'll see more of that. I think we'll see more operating company DATs that are trying to be ecosystem building the ecosystem out. So whether it's Solana, whether it's Sui, whether it's Avalanche, whether any of these ones that've got DATs, we could probably see them having VC, providing liquidity for lending, doing all things to grow the ecosystem, and that will grow the NAV per share.
The aftermath of such events requires time for digestion. Capital must return, confidence must rebuild. Market participants need to recover psychologically and financially. This healing process typically takes months, not days. But once complete, markets often emerge stronger, with excess leverage flushed out and structural stability improved. Pal envisions a more mature crypto ecosystem where capital flows not only into tokens, but into operating companies, venture structures, and ecosystem development platforms. This evolution mirrors traditional financial markets where capital allocation becomes more strategic, value-driven, and long-term oriented. As crypto regulation improves and institutional participation expands, capital formation mechanisms will become increasingly sophisticated. This process ultimately strengthens the entire ecosystem and supports sustained long-term growth.